there is going to be major support. Once you get down to this 111 to approximately 110 level, you can see all of these high pivots right along here before the latest breakout. This is going to be where the bulls need to make a stand on price. It's not far away at this point, only about $4,000 to $5,000 away. But again, that is going to be unbelievably key. Last thing I want to show you here is an additional trend line I'm watching. It coexists right with that same level. This is so important for the bulls because again, upsloping trend line, flat top of support, two support levels. As long as the bulls can hold the line here, we're good. If you break this, you're going a lot lower. So watch 111 to 110 on Bitcoin.
Bitcoin is under pressure as it approaches a critical price zone, trading just above $113,000. The market focuses on the $111,000 to $110,000 area, a region marked by several previous highs and a key upsloping trend line. These two major technical markers are now coming together, making this spot significant for traders watching whether Bitcoin can avoid further heavy losses. The recent selling has put buyers in a tough spot, but bulls are expected to defend this level, as a break below could lead to much sharper declines. Technical signals show that if this zone holds, it could act as a short-term base. Otherwise, the risk of a more significant slide grows. During a recent appearance, Gareth Soloway explained how this support range has become a line in the sand for bullish traders, guiding where price action could turn next. He highlighted that the technical overlap, where a strong upward trend line meets the flat resistance of past pivot highs, makes it a crucial battleground for both buyers and sellers. Gareth Soloway stressed how critical this level is. If bulls can hold the price above $111,000, the market may stabilize in the near term. However, if this floor breaks, it opens the way for much deeper losses. So many in the market are watching closely to see how this plays out as volatility remains high. Stick around as we bring you more clips from Gareth Soloway's explosive analysis with David Lin on the general markets. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
You knew this was going to be a big day. Did you make any positions prior to the announcement? Obviously, nobody knew exactly what the announcement was going to be.
Yeah, so in my humble opinion, I don't think it's the tariffs necessarily just them. We got the jobs data this morning, the non-farm payrolls coming in weak on the day. And I think, what we saw is earlier this week, the PCE data was a little hotter than expected, and that's inflation data for those of you at home that may not know that. But the combination of a more hawkish Powell, inflation creeping up, and a weaker jobs report, I think that already set the table. And then it's almost like the tariffs just pushed us over the cliff in the markets. And I think that's really what's going on. And just a couple tidbits here on this non-farm payrolls number. So 73,000 is where we came in. 106,000 is what was expected. So it's not a huge miss, but this is where it gets more interesting. Unemployment rate inched up to 4.2%, but the participation rate continues to decline. These are people that are just giving up on looking for jobs. And the U6, which is the underemployment number, spiked to 7.9%. And again, underemployment means someone can find part-time work, but they're not able to get that full-time job. So essentially, they want the full-time job, they just can't find it, i.e. half unemployed, essentially. So I think all of this combined with an uptick in inflation is really making the markets nervous because remember, these tariffs are going to go into effect and they will cause some sort of slight, if just slight reaction in inflation, which means higher inflation, but a weakening economy. And again, we know what that means. That's that favorite term of stagflation. So I think that's where we are right now, David, and why the markets are having such a big drop. Now, I think honestly, just to throw this out to you, is if the jobs report came in really strong, I bet the markets would be fine today. I mean, they'd probably be down a little bit, but not 1.5, 1.6% on the S&P. The combination of all these kind of, cuts on the system or on the psychology of the investor is coming with valuations on stocks basically at all-time highs, right? I mean, the stock market at a forward PE of 23 on the S&P, that is very historically rich. And so you have all of these kind of a confluence of factors that are spooking markets today. Now, the bigger question is this the start of something bigger or not? And let's go into the S&P chart here. I want to show this to you because I do think this is worth taking note. Look at what's happened here recently. So this is the daily chart of the S&P, and we have the low from October 2023 to the April 7th obviously 2025 low, that big sell-off. Now, what I did here, I simply took a line there. You can see I just take that line, each point, connect them, and then drag a parallel up to the highest point right here, and look at what we did yesterday. We gapped up on these earnings. And one of the most important things for me in trading and investing is to notice the price action. And what we see is when you have good news, like we had Meta and Microsoft earnings, great news, the stock market gapped up a mile. And when it can't hold those gains, it tells us that bigger money is dumping. They're dumping into the retail buyers here. And I want to show one last thing here. If you look at since Monday we opened higher, we sold off and closed flat. Tuesday gapped higher, went negative. Wednesday gapped higher, went negative. Thursday gapped higher, massive reversal. This is all institutions unloading into retail FOMO. And again, I always try to scream from the top of my lungs to let the retail investor know, but this is a telltale sign that something was going to break here.
Right. So would you be buying the dip right now?
So I wouldn't be buying it yet. Again, in general, I've expected a drop pretty much for the last month or so. So again, we're just starting to see this. So number one, the chart here, if we look at this trend line, you can see this was the beginning. The high here was the beginning of a lot of sideways chop, but eventually the big decline, and vice versa. The lows of this were the big rallies. And so, if you look at this as a chart, you would say, okay, you're at the higher end of this parallel. The odds favor more downside. The other thing to keep an eye on here is the data. So right now, what spooked the markets is we're finally seeing a significant weakening in the labor market and an uptick in inflation. And I think the key is if all of a sudden, let's say in the coming weeks and months, inflation calms down and the labor market strengthens, okay, markets would probably resume their uptrend. I just don't think that is going to happen. I think, again, like you just showed from the CNBC article, is that you have these new cost structures on companies. Now, they have a choice. They either can suck up the tariffs and take the hit themselves, and in doing so, they're going to have to fire people because that's an additional cost they're taking on, or they pass on that inflation to the consumer, and that hurts the consumer, the public anyway. So really, there's a no-win situation for the consumer, one way or the other. Whether they take the tariffs and eat them, they're still going to have to lay people off, which will hurt the consuming public, or if they pass along the inflation. And I think that's what we're starting to see. And I know a lot of people have been shocked, even myself, at how long the rally has lasted. I think, honestly, it's just been a delayed reaction. There were so many starts and stops with tariffs. Okay, we'll postpone, we'll do this. But now there's finally starting to soak through the system. And I do think there is going to be repercussions in the system for that.
What we could look at is a potential recovery type scenario where some of these tariffs are taken offline. That would be a big boon to the markets. Would you bet on that?
No, and I'll tell you why, is because we basically know his playbook at this point. You're right. The big tariffs that were announced today, those aren't going to stick, and I don't think the market expects them to stick. What the market now expects is that every partner, it's 15%. And so we now know that once a deal is done, it's basically going to be 15%, give or take, and that's where the market is now pricing it in. What the market wasn't pricing in is the labor market weakening and an uptick in inflation. And I think the combination of understanding, okay, 15% hike in tariffs across the board, that is going to cause a price hike. Now, who eats it? That's going to be the question. But either way, the consumer ends up hurting from it one way or the other. I looked at the Fed Watch tool this morning after the jobs data, and yesterday after the Federal Reserve came out on Wednesday, the market was only pricing in now one cut, not even in September, just one cut in the whole entire rest of the year. After the jobs data today, it's back to a cut in September with a 67% chance, which is very, very high, and ultimately another cut later this year. So we're back to two cuts because of the jobs data. And so, again, the market is swinging towards it. And one thing I can show you here, look at what happened to the 10-year. And so this is telling you all you need to know, right? All of a sudden, the 10-year just dove and broke a major support trend line. That tells you the economy is now really being recognized as weakening, and the Fed is likely to cut rates. A minor note, the Fed does not control the 10-year, the long end. They only control the short end, but they can influence it, obviously, by different things like cutting rates.
The market responded quickly after a weaker than anticipated jobs data revealed only 73,000 new jobs, compared to the 106,000 expected. Unemployment has also risen to 4.2%, with underemployment at 7.9%, but fewer individuals are actively seeking work. Inflation came in higher than expected earlier this week, and the Federal Reserve's tone became more hawkish. This already disturbed the market, and the news of fresh tariffs pushed it considerably down. The S&P's high valuation has made investors more sensitive to negative news, and recent trading implies that large institutions have been selling into strength, leaving retail buyers vulnerable. With the job market weakening and inflation increasing, the odds of further Fed rate reduction have grown, but uncertainty over tariffs and economic data continues to weigh on stocks. Let's watch more clips from Gareth Soloway.
Any Bitcoin levels you can educate us on at this point after today?
Yeah, so let's talk some technical analysis here. So I've been bearish and calling this a bear flag. A lot of people would say, "Oh, wait, isn't this a bull flag?" Right? Because you have an up move and sideways consolidation. The reason it is not a bull flag in technical analysis is because you always take the most dominant signal in recent history. That was this candle right here. This is a topping tail. It's a a bearish reversal signal of price. And so you can see reversal in price this way, and then the consolidation is actually bearish here. And notice how price is breaking down here. Notice, by the way, with the stock market as well. So that risk asset factor is playing a role here in bringing Bitcoin to the downside. Now, there is going to be major support. Once you get down to this 111 to approximately 110 level, you can see all of these high pivots right along here before the latest breakout. This is going to be where the bulls need to make a stand on price. It's not far away at this point, only about $4,000 to $5,000 away. But again, that is going to be unbelievably key. Last thing I want to show you here is an additional trend line I'm watching. It coexists right with that same level. This is so important for the bulls because again, upsloping trend line, flat top of support, two support levels. As long as the bulls can hold the line here, we're good. If you break this, you're going a lot lower. So watch 111 to 110 on Bitcoin.
Okay. Gold shot up dramatically. Big move following weeks of consolidation. Let's take a look at what's going on with gold.
Yeah, gold has broken a wedge pattern to the downside. It's getting a bounce back here. But what's interesting is that when you break a wedge in technical analysis, that wedge, those two trend lines now become significant resistance. Ultimately, mid to long term, I think gold is going to 4, 5, 6,000. But in the shorter term here, over the next 3 weeks to a month, this is going to be resistance, and you have to understand that price is likely going to get rejected here. I know that's counterintuitive after what we're seeing in the markets here, but it's not my job to guess on things. It's my job to translate the probabilities in the charts, and this tells me that you should have major resistance around 3,400 or so, and price likely will have one more dip to the downside. My big support level where I'm going to start accumulating is around 3,140 right here. Pivot high, pivot low, that tells me there's support right in that range. So again, near term, maybe a little upticking here, but for the most part, in the next couple of weeks, I would expect further downside until we get to about 3,140, and then I would start to accumulate.
Yeah, your thoughts on the dollar, Gareth?
Yeah, I think the kicker is this. So interestingly enough, the dollar actually broke its downtrend recently. So let me just walk through this. Why is it a downtrend? Well, because you have the highs on this, high, lower high, lower high, lower high, lower high, all the way down, and lower lows, right? So what's interesting is here, right over here, we made a low, higher low, high, higher high. And that tells me that, again, the trajectory of the dollar in the near term, remember, I'm a short-term trader, is now bullish. Now, it doesn't mean you're not going to pull back like we see today. We're obviously pulling back because people are now anticipating stimulus and Federal Reserve cutting and all these other things, right? But look at this. You have this classic trend line right through here, which was our little breakout level, and even like a little inverse head and shoulders. You can see shoulder, head, and shoulder, and we've broken out. And so what I would look to do on the dollar is I would say start to go bullish around 98 in the near term. 98, we should get a pullback into that. That's going to be technical support now, and we should turn back up. I think we go up not that much. I mean, there's not a lot of upside here, but there's a trend line I've been following right through here at around 100.75. So I think you get a pullback, one more move up to about 100.75, and then I'll have to reevaluate at that point to see what's the next move in the dollar. Yeah, so I think that you've seen the semiconductors get way over their skis. We've seen, again, incredible moves. They are starting to correct here. I would say that, again, look for a pullback in that asset class to continue, maybe 10% off of the highs, maybe 15%, then reevaluate. Overall, what I'm looking at is the Chinese stocks are looking very attractive to me down here. The valuations are low. And then, again, I'm much more in this environment where the markets are so pricey, I'm looking for what sectors are cheap, and the cheap areas are the drug stocks right now. Obviously, they've been hammered by a lot of what the administration has talked about in terms of pricing, but again, usually from fear comes opportunity. And so I like the dividend that Pfizer pays, for instance, where it's located on the chart. Merck is another one. I would expect those to outperform along with other outside country stocks.
Is 120 kind of the new 115 to 120 kind of the new floor here? Is that one way to look at it?
The new ceiling, yeah. So I would say really the topping tail. The way you view it is when you have a topping tail in a chart, that high now becomes your break point. So the topping tail rules the roost as a bearish reversal signal unless price closes above it. So I think that was 123,200. So I would remain neutral to bearish on Bitcoin down to that 110, 111 level and then reevaluate. But if Bitcoin can eclipse 123,200, now you get another bull move likely into the 130s would be your next spike higher. So if you're looking as a bullish bearish signal, that topping tail high is your break point. What I've learned is that, my best predictions are shorter term, a few weeks out to a few months out. Whenever you hear people calling for these crazy price targets, it's usually near a cycle top or a pullback. And so always remember
that's exactly what I told a friend at dinner today. Yeah, okay. Yeah.
I mean, 2021, look at that. I mean, we were hearing targets of $500,000 by the end of the year. And it was already October when I did that interview with you where I said, hey, it's at 68, look for it to come back to 20,000. And it did, obviously. But the key is just be aware of that, folks out there. Just aware that people's emotion tends to dictate these kind of crazy things. In reality, especially with an asset now that is multiple $trillion, it doesn't mean it can't double. And I think it will double eventually, but it just can take a little bit more time. There's more money that has to be soaked up to drive it higher. Programming for retail investors has been to buy the dip. And so you're going to see most likely a much slower decline, but I actually think it could be even bigger by early next year, meaning that it's not going to be this massive flush where we go down in a matter of a week, 10% or so, but much more of a 3% down, 1% up, 3% down, 1% or 2% up type market step down. And I think the buy the dippers are going to think this is a no-brainer. It's down 5% or 3%. Let's buy. And they're going to look right for a day or two, and then it's going to go lower. And they'll say, all right, well, this has to be the bottom, and they'll buy in. And I ultimately think the tariffs are not as big of a news. The market has digested that. We went through Liberation Day. We kind of get the whole Trump tariff thing and where things are going to settle out. Again, it's all going to come back to the U.S. economy, which is, again, remember, for these companies in the S&P, they rely on consumer spending. So if you see a slowdown in the economy, how do you justify a 23 forward PE on the S&P? You just can't. And I think that's going to be the kicker, is that slowly realization will take markets lower over the next 6 to 12 months.
Technical analysis after recent price action highlights Bitcoin's recent weakness, which Gareth Soloway described as a textbook bear flag. Despite some thinking that sideways movement after an uptrend should be a bullish pattern, he stressed that technical signals have been clearly negative, pointing to a sharp reversal candle, a topping tail that turned the trend. Since then, price has failed to rebound, breaking down and confirming further bearish momentum, with selling pressure from risk-off moves in stocks adding to the drag. He noted $123,200 as a critical level. Unless Bitcoin closes above that point, the probability leans toward a dip down to $110,000 to $111,000 area, the next likely support. Gold has also been in focus after a dramatic rally out of consolidation. Even with a short-term bounce, he explained that technical resistance around $3,400 is likely to block further upside for now, with support to watch at $3,140. The dollar's trend has shifted, with a break of its persistent downtrend and higher highs confirming a near-term bullish swing, targeting the 100.75 area, but possibly dipping back to the 98 support first. Chip stocks, he argued, have run too far and could see another correction, while he sees value in oversold Chinese equities and large pharmaceutical names like Pfizer and Merck, which pay steady dividends and have weathered policy and pricing worries. According to Gareth Soloway, the classic buy-the-dip strategy may not work quickly in this environment, as slow market declines and changing fundamentals could challenge retail buyers. He believes high S&P valuations could drift lower as consumers and earnings soften through the rest of the year. As we wrap up, do you think this $111,000 to $110,000 support level will hold for Bitcoin, or are you expecting a deeper drop soon? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.